time then to talk a little more about markets and really, what's expected in the days to come, given that we are now in the midst of the corporate earnings season. And for that, we've got TCG AMC's Chakri Lokapriya, who's joining in right here. Chakri, good evening. Thanks so much for taking time out for us. Let me begin by asking you what you've made of the earnings season so far. Of course, we've only had Infosys and TCS in the big ones, but there's also Hindustan Unilever, Reliance Industries expected this week.
You know, at first blush, TCS beat numbers. They've justified in maintaining a stance that the revenue growth will be faster than NASSCOM guidance. They come in at 14%, which is a good thing. The digital contribution is about 13%, which is also clearly good. And in terms of order inflow, has been marginally better than expected. So while largely it is have met expectations on both revenue as well as bottom line, I think net it bodes well for the industry at large. And coming to Reliance Industries, I think the GRMs currently are about $8.50 for Singapore GRMs. But given Reliance Industries' alacrity in shifting production from gasoline to naphtha, I think the GRMs will be marginally better than expectations, than what the street expects, closer to around $9. And the valuations are very undemanding at about the refining businesses at 6 times, the petrochem at about 6 times. So I think there's still sufficient upside for Reliance Industries. And finally, about Hindustan Lever, the stock is trading at 40 times. The slowing rural demand, higher advertising spending, and therefore the levers for growth being much better than expected are kind of limited, so we maintain a neutral stance on Hindustan Lever.
Chakri, let's talk about the way global markets are responding to every piece of economic data. Just today, the Chinese data is something which is spooking equities worldwide yet again. What are your observations of the potential risks India is prone to because of global worries?
I think from a global perspective, there are still just 2 factors. One is slowing China. The recent data points of a 20% fall in their imports is worrying for its trade partners who are more export dependent economies. On the other hand, a US Fed rate hike is now a 2016 phenomenon, and I think initially when it happens, it will be a knee-jerk reaction, but overall that is kind of priced in. So the main factors is the market from a global, Indian market from a global perspective has to now gravitate towards looking at where the domestic India recovery is going to come from. And corporate earnings revival in 2017 is more important than the global factors.
Chakri, the first phase of polling has begun and in fact is over there in Bihar. How do you think the elections in that state could be a factor to watch from the market standpoint?
I think Bihar elections is a short-term factor in the sense that if there is a victory for the BJP government, it's clearly a big positive for the markets. On the other hand, if it turns out to be a kind of a situation where it's not such a bad loss, then the market might initially knee-jerk negative, but overall again consolidate back up.
Let's talk about the valuations then of our market and what you're making of them at the current levels. Are you bullish or bearish? Do you believe that, we should brace ourselves for lower levels, or are we now going to build on these levels?
The MSCI India is trading at about 16 to 17 times, which is not expensive. And on the other hand, the recent IIP data and as well as consumer durables figures were better than expected. We are beginning to see hiring pick up. If you look at Naukri.com's, where hiring was up 18%. And this gives us the feeling that the urban demand is more broad-based, i.e. it's expanding to tier 2, tier 3 cities. And therefore, we are positive on the market at current levels.
So having said that then, Chakri, how are you positioning your portfolio right now?
there we continue to be cyclically focused. We expect to see a revival of domestic cyclicals, and engineering goods, capital goods, infra, better than expected garment spending should all help the cyclical sectors. On the other hand, a fall in commodity prices is positive for engineering. So while we are overweight on cyclical domestics, including export-oriented company sectors such as IT and pharma and textiles, we continue to remain underweight on utilities, especially given that plant load factors are at very low levels at about 57% due to lack of availability of coal as well as gas. And of course, metal companies are cyclically at the bottom, and so we continue to be underweight those sectors.
All right, Chakri, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.